What's up, fam? Welcome to another episode of Simply Finance with Shane White. It is Monday, April 27th, 2020. This is episode 32, and today we're going to talk about a concept, and not really a concept, just kind of a overarching understanding that I want to make sure all of you have for the stock market. It's something that I've probably alluded to or talked about a little bit, and that is pre and post market hours trading. So if you're new to the stock market, there for sure have probably been times where you see the stock close one day at a certain price. The next day when you wake up and you wait for the market to open, the bell goes, you go to sell it, and the price is different. I'm going to kind of dive into why that is and how you can actually help up your game and evolve what you're doing in the market. Before I get started, I am going to talk about the market performance today. So the big three I always talk about are all up. The Dow up 1.24% today, the S&P up 1.3, and the NASDAQ up 0.97, so almost a whole percent. There is about an hour and a half left of trading today, so things could shake out a little differently. And then I'm also, as I previously mentioned, bringing you guys the Shane Index. So the index that is based off of the investment that I put back in the market, a very small one, but as a test to help all of you, just kind of show you, what it takes, even if it's a small amount of investment, how it's performing. And I just want to be honest with myself and with all of you of how it's performing against the market. So like I just said, the general market is up today. My Shane Index is actually taking a rough day. It's down 1.8%. And I kind of wanted to explain why briefly before we hop into the episode. So as I have talked to all of you about, I've mentioned this over and over, and it's probably, if there's one key understanding that I will probably talk about forever on this podcast, it's making sure you're diversified. And this is a perfect example of why you need to always have diversification in your portfolio. So like I said, it's not been a good day, down 1.8%. And actually, since I checked, it's gone down further. I'm down 2.25%, which is a rough day for my little index. And it's not because it's really not because of it's not because my entire portfolio is down. And this is where the power of diversification can really be shown. So I'm actually gonna go down. I'm gonna share my screen for all of you watching. Oh no, I'm not. I'm on the wrong thing. I did this last time. I'm on two computers here. So I'm just gonna talk through this. If you click on the link in my profile, or in the show notes, stock market rebound tracker, and you go to the first tab, which is called practice sheet. And you can see there USO, American Airlines, United Airlines, Amazon, and Starbucks. Those are the companies I walked you guys through that I invested in. And what you see is between American, United, Amazon, and Starbucks, all those companies are either slightly down and slightly up. But what happened was I also invested in USO. And if you guys remember, I gave USO not an enormous share, but I gave them 15% of the portfolio weight. They are taking a beating today. They're down 18.5% today with the change in their portfolio makeup. This was something that out of my control. Nothing crazy new necessarily happened in just pure oil prices today, but USO in particular is rebalancing their portfolio. Investors are taking that in a negative fashion. And it's smashing this stock today. This is a prime example of why you diversify. If I would have been someone who was like, you know what, oil's down super low, I'm going to invest in this, it's going to pop, and I put my entire portfolio weight, invested all of my dollars into USO, I'd be down nearly 20% of what I invested, which is an astronomical loss over that short of a period of time. But it's down 18.5%. Like I said before, my portfolio is only down 2% essentially. How does that happen? I diversified. I added investments across other companies. They're all doing better than that. So the average weight of the entire portfolio is not down quite as much as it could have been. So just wanted to kind of explain that to you. That's what's shaking up today. And since I've invested last week in this, And it's important to know, and it's important to see this in reality, that this can happen in a good or bad way. Diversification just kind of allows you to keep growing. And in my opinion, in my situation, because I have one stock that's killing me, it's going down, but it's not going down as much as it could have. So that's diversification in a nutshell. All right, today's concept. So as I previewed at the beginning, we're going to talk about pre and post market trading. So what is that? As a lot of you know, the stock market in the U.S. is open from essentially, let's see, it depends on, so the pre and post market are basically, I'm going to back up, are extra trading time on the front end and the back end of the market, okay? So because the U.S. stock markets are open from 9:30 to 4:30 each and every day, 9:30 to 4, right? 9:30 to 4 every single day. Those are when all of us can hop in and I'm sorry, I'm just checking one thing here on here. That's one, yeah, 9:30 to 4. I don't know why I got that mixed up in my tracker. Anyway, 9:30 to 4, the market hours on Eastern time that we're all used to trading. Now, that's when the majority of all the investments are being made, right? That's when a vast majority of all the volume traded all day happens. What does happen, though, is there's these two periods. There's the pre and post market trading. And if you have a brokerage account, like I've said a million times, I use Robinhood. Over time, I was able to unlock pre and post market trading in Robinhood. So I'm able to invest 30 minutes before the market opens, and I can invest, I think it's like an hour and a half after the market closes. Now, how is that beneficial and how does it work? So the markets are closed, but what has been created are these ECNs, or electronic communication networks, that instead of there being a broker in the middle, these ECNs essentially, if I simplify this as much as I can, they're really becoming this central communication hub that, like, I want to trade a stock, I'm connecting directly with the person selling. It just kind of is a simpler way to connect selling and buying stocks. So those are live, and those help investors match up and sell. Now, nothing else changes as far as like what's technically happening. It's just extended hours. And what happens is there's not as many shares available because obviously not as many people are taking part in this. In general, people, are working and, involved in the stock market from open to close. Really big institutions or big investors are going to be the ones who probably play in the pre and post from time to time to make big moves on certain stocks. And then you're going to have a lot of individual investors like ourselves who, if you are available and have the time, you might want to try to put in an extra sell or a buy. And I kind of go through the risks, the dangers, and then the benefits of doing this. Okay. So I'll start with risks and dangers. Really, some of the main ones are there's less liquidity. So there's just in general less people buying and selling during this time. So there's not as much volume available. And if you remember from one of the first episodes where we talked about having a stock you want to buy versus someone wanting to sell, and they have to, supply and demand has to match, and then they boom, connect, stock is traded, and you have your share or you sold your share. There's less of that going on. So there's also wider spreads. The price that someone's willing to sell it at and the price that someone's willing to buy it at, instead of millions of those transactions happening every second and they connect and trade, there's less happening. So the likelihood of you actually getting that transaction to settle is not as likely. And then, of course, another risk is you're really going up against the resources of large investors and institutional investors, really. So these major trading firms have a lot of resources and a lot of ability to quickly make the deals work. You're up against those in a small volume market, if that makes sense. Some of the benefits. I mean, obviously, a lot of companies who are going to release information are going to be trading on, they're going to be releasing information before and after the market. Okay, so if a company is going to release earnings post-market, this is going to be great for you because you can actually hop in and get this that you can get this done quickly. So you can hop in after the market, after you've heard this company did well or didn't do well from their earnings release, and you can make a trade. That's what most people are doing. They're going from mergers or acquisitions information. They're going off of earnings reports, and they're trying to make a move before the general public has the ability to do so. And really, it's just the other main one is the convenience of additional time. So if you're someone who's busy, this just gives you extra added time to have the ability to try to trade. So it's not that complex of an idea, but I wanted to make sure you guys understood this, because really what's happening when you see a price close at the end of the day and the next day you go in to buy it and it's different, it already moved, it's because people were still trading after the market and the next morning before. Not every stock trades pre and post, but most do on the major exchanges. And that's really all it is. So if you want to get involved in that, I would suggest the only one I've really done this through is Robinhood. I would get on there. You can go into your settings and ask to be approved for pre and post market trading. I don't know exactly how they decide who gets approved and who doesn't, but that's how I did it. And it's great. I honestly don't use it a lot, but it's just that extra ability to make a trade if you feel like you really need it. Especially if a stock's doing great or doing poorly off of fresh news. That's like the best thing you can really use it for, is like hop in and you can save a few percentage points of gain or loss sometimes if you're on top of it. So that's all for today, folks. I hope you now know what that means. If you hear pre or post price movements, it's coming from these small amount of trades coming before or after the market. And it can be frustrating if you don't know what that means and why the price is moving. So I hope this helps. Hope this added some value today. It's a simple but important topic. And yeah, happy Monday. Good luck this week in the markets. I'll keep you posted on all things from the Shane Index to the market performance. We'll have a lot of good concepts this week and potentially a few guests. Exciting stuff. I know everyone's ready to get more guests and not just hear me talk. So I appreciate all you guys for listening. Thanks always for supporting SimpliFinance. And I hope you guys learned something today. And we will be back tomorrow. All right. Have a good one, everybody. Goodbye.